You know the dream. It's the ultimate goal for almost every owner-operator out there. You buy your first truck, hit the road, build up some capital, and then boom, you add another one and another. The standard thinking in this industry is honestly pretty simple, right? More trucks automatically means more profit. I mean, it just seems like basic math. You scale up your assets, you move more freight, and your margins just multiply. But actually, scratch that. It's not just a but. Scaling a trucking business is rarely a straight line to pure profit because there is a hidden dynamic shifting right beneath your feet every single time you add a vehicle.
And that brings us to the million-dollar question. And I mean literally, sometimes it's millions. What happens when your insurance risk grows right alongside your fleet? See, this is the hidden trap that completely blindsides growing operators. They buy the trucks, they hire the drivers, and then suddenly, bam, their insurance agent drops a bomb on them. Hey, you no longer qualify for your old policy. They've crossed this invisible threshold, and with it comes a sudden, incredibly complex shift in risk, liability, and of course, cost.
So, let's get into it. Today, we're completely demystifying exactly how scaling your trucking business fundamentally changes your entire insurance reality. We're looking at fleet versus non-fleet trucking insurance and why misunderstanding this shift can become a massive, massive growth trap. Getting this right isn't just about saving a few bucks on premiums. We're talking about the absolute long-term survival of your company.
All right, here's our game plan for this explainer. First, we'll look at the fleet transition. Then we'll compare non-fleet versus fleet, dive into the underwriting shift, break down the claims and cost impact, and finally wrap up with smart fleet management. Let's go.
First up, the fleet transition, what it actually means to cross that threshold.
Okay, let's dive right into this core difference. Non-fleet versus fleet. Honestly, they are two totally different worlds. So, when you're a small startup or maybe an owner-operator with fresh authority, you start off with a non-fleet policy. This usually covers 1 to 4 power units. It's built on a pretty straightforward scheduled auto structure, which basically just means specific trucks are listed individually. It is super easy for an insurance company to understand, quote, and underwrite, mostly because they're looking at a really small, predictable footprint. But the very second you hit that 5-truck lark, poof, that simplicity vanishes. You've officially entered the world of the fleet policy. Now, this is designed for growing companies and larger carriers, and sure, while it might offer broader automatic coverage, it triggers a heavily complex risk evaluation. Underwriters aren't just looking at a handful of trucks anymore. It's a totally different beast. And this brilliantly illustrates exactly what I mean. With a non-fleet policy, the insurer evaluates the isolated risk of a single unit. They're basically just asking, is this one truck safe? Is this one driver qualified? But when you jump to 5, 10, or say 40 trucks, the risk becomes totally interconnected. More trucks means more drivers, way more miles, more chances for accidents, and obviously more lawsuits. They are no longer evaluating isolated doubts on a map. They're evaluating an entire living, breathing corporate network.
Which brings us to the third piece of the puzzle, the underwriting shift. Why insurers start looking at your company's culture?
At this stage, underwriters basically pull out a massive magnifying glass. For a non-fleet, like we said, they review a few trucks, focus on individual drivers, and the culture check is pretty minimal. But for a fleet, whoa. The underwriting goes incredibly deep. They want to see your entire maintenance system. They are heavily scrutinizing your hiring standards and your driver turnover. Oh, and high turnover? That absolutely terrifies insurers. Constantly cycling in new drivers creates massive training gaps and just wild inconsistencies in safety. So they demand formal safety programs, documented compliance departments, and you better believe they are tearing through your CSA scores. Ultimately, growing your truck count without building the underlying structure creates a massive, totally unacceptable risk in the eyes of an underwriter.
All right, moving on to number 4, claims and cost impact. Let's talk about the real financial stakes here.
So claims impact these two policies in completely different ways. Let's say you have a non-fleet policy, maybe you're a 1-truck owner-operator, and you have one severe accident. Your premium could easily double at your next renewal. Why? Because 100% of your risk is concentrated in that single truck. Now, on a fleet policy with, let's say, 40 trucks, a single accident is still bad news for sure, but the financial hit is distributed across a much larger premium base. The insurer is looking at the fleet's overall performance. But, and this is a huge but, there is a terrifying flip side for fleets. Large fleets are giant targets for lawsuits. If plaintiff attorneys can prove your company has a weak safety culture or negligent hiring practices, they are not just going to sue over the accident. They will literally put your entire corporate culture on trial. This is exactly what invites those nuclear verdicts you hear about, the ones that easily blow past tens of millions of dollars. So the crucial point is really driven home by this terrifying real-world example. There was a carrier that expanded way too fast, jumping from just a couple of trucks to around 10. To keep those new seats filled, they rushed it. They hired inexperienced drivers, and they really weakened their oversight. Well, accidents started piling up. Because of that rapid, totally unstructured growth, their insurance renewal jumped from $90,000 a year to a jaw-dropping $240,000 a year. Let that sink in. That right there is exactly how growth, without safety, becomes completely unsustainable. Which leads us straight into our final section, smart fleet management. How to actually fix this. Well, before we look at the solution, we kind of need to highlight what not to do. Here are the 4 major mistakes that will completely destroy your underwriting profile. Number 1, growing too fast without safety structures in place. Just don't do it. Number 2, weak driver screening and high turnover. Remember, putting unsafe drivers behind the wheel is the fastest way to ruin your rates. Number 3, poor fleet maintenance. Because if a maintenance failure causes a crash, the claims are just astronomical. And number 4, weak documentation. If you're missing safety manuals, hiring procedures, or critically your loss runs, underwriters will panic. Missing records scare them badly. Now, the really smart fleets, they do the exact opposite of those mistakes. It's like a cheat code to actually lower their insurance costs over time. Step 1, you absolutely must build a rigid, heavily documented safety and compliance culture. Train drivers consistently, investigate every single minor incident internally, and obsess over your scores. Step 2, implement aggressive, scalable maintenance procedures. And step 3, which insurance companies absolutely drool over, deploy technology. Put dash cams in every cab. Use telematics and ELD analytics to monitor safety. Because technology reduces fraud, it corrects unsafe behavior in real time, and it drastically lowers your overall claim exposure. When you take a step back and look at the whole shebang, this is the core truth you really need to walk away with. As trucking companies grow, insurance becomes less about the trucks themselves and way, way more about your business management. The second you cross that fleet threshold, underwriters are no longer just insuring a piece of rolling equipment. They are insuring your management capabilities. They are insuring your systems, your oversight, and your culture. Understanding this shift, that is the secret to growing safely, keeping your premiums in check, and actually surviving long-term in what we all know is a brutally competitive industry. So I'm going to leave you with one final hard-hitting question to ask yourself about your own business today. If an underwriter looked under the hood of your company right now, would they trust your operations culture? Really think about it. Build your systems before you buy your next truck. Thanks so much for joining me on this explainer, and keep learning.